Hello and welcome to the Wealth Management Invest podcast. I'm your host, David Bodamer from the wealthmanagement.com editorial team. And this episode, I'm excited to bring on David Levi, who is a managing partner and chief executive officer of Brookfield's Global Client Group. Hi, David. Welcome to the podcast.
Hey David, how are you?
I'm doing well. So yeah, we got the David back and forth thing going
Yeah,
for this
exactly. This could be
one.
very confusing.
So before we get going, there's some really interesting research you guys have done just in addition to just the overall kind of products that you guys have in the space. Before we get into that stuff, I just wanted to give you a chance to maybe give folks a little bit more of a bio and even a little bit more about Brookfield and
Sure. Yeah, no, happy to. And again, thanks for having me. So I am a managing partner and CEO at Brookfield. I run what we call the Global Client Group, which means basically I look after all things client related at Brookfield. That includes our institutional business, but it also includes our wealth focused business. Our history is one that has been very focused on institutions for a long time. But over the last 4 years, we have built out a very dedicated and very scaled business focused on wealth, and so I think we'll talk mainly about that. But broadly, just to spend a minute on Brookfield, we manage about $1 trillion, all in alternative asset classes. That includes real estate, that includes infrastructure, private equity, renewables and transition, and credit both at Brookfield as well as via our ownership of Oaktree Capital. So we've been investing in the real assets and private equity credit space for decades, and as I said, we've historically really focused on institutions globally, but really are focused as well now on bringing our institutional capabilities to the wealth channel around the world.
Yeah, it's interesting. I'm sort of new to the wealth space myself. The past kind of couple of years being more focused on it, but before that, I covered real estate and I spent a lot of time, even commercial real estate more broadly, but even a number of years specifically on retail real estate, and would always. And so I know Brookfield from that perspective for a long time, just like all the stuff, the big retail portfolio, the big office portfolio, other asset types. But so it's just it's kind of like almost like a full circle for me to kind of come back and like now talking to Brookfield again as as you're engaging with this new audience. So I find it really interesting. And so yeah, and related to that, one of the things that you guys put out recently was this study looking at the power of alternative investments, and that had a lot of really interesting data to it. We'll have a link to it in the show notes for folks. And one of the undercurrents that I found very interesting about it was like how much the report talks about why this is important for advisors and like what from a practice management perspective. There were a lot of different parts of that. Maybe we can even get into some of that, but just I thought that was an interesting way to position this and was curious about like the decision to do that.
Yeah, yeah. Look, I think as an industry, alternative managers as well as wealth management firms who provide alternatives to their clients acknowledge that education is really, really important, and we're no different. But historically, education was, I would say, maybe defined as teaching people about different asset classes and what is private credit, what is infrastructure, what is private real estate, and maybe a bit of how to fit those things into your portfolio. And we do that. So we have education programs on those kinds of things. But we actually decided to take a slightly different tact, which was how do we help financial advisors actually have conversations with clients about alternatives, not about what it is, but really about how to think about them as a diversifier in their portfolios, but to be able to have the conversation with the client. A financial advisor actually needs to understand how the client comes to the table, so to speak.
Mm-hmm.
And so we undertook this research really to understand the attitudes of clients and the attitudes of financial advisors to almost unite them together and help them have better conversations, in this case about alternatives. And it's a different approach to what many are doing. And our view is not only will it help advisors have better conversations with clients, but it allows us to create valuable programs and tools for financial advisors to talk to clients, and different kinds of clients, and in terms of where they are in their journey toward alternatives and what they want.
Yeah, one of the parts that struck me was that it seems like there's a value here, even if the client isn't using the alternative necessarily, but just, that it can be a good fit for lots of different investors, and there's some interesting profiles you have in there. But just from like an advisor practice management standpoint, advisors who have this capability and can have these full conversations about portfolio construction, where this thing could be weighed, and whether or not it's used. It's just the fact that the advisor is knowledgeable about it seems like something that could be like a feather in their cap, just like, in
Yeah.
terms of like positioning, in terms of their client relationships, just clients. All right, this person, they understand all these different complexities, they understand these options, and even if I'm not using it, I'm glad that they understand it. Is that a fair assessment of like some of your findings here?
Yeah. Just as an example to your point, something like 90% of clients who use alternatives want their advisors to stay on the cutting edge of knowledge. So that's not that surprising. If you use alternatives, you want your advisor to know what the next thing around the corner is. What's really interesting is almost 70% of people who don't use alternatives want their financial advisor to be knowledgeable. And I think it just goes to the fact that people who don't use alternatives today actually plan to, and
Mm-hmm.
the data would support that, and therefore they want their advisors to be equipped. I think there's a view in the industry perhaps that for the most part, people who don't invest in alternatives today probably are not investing in alternatives because they don't want to, or don't intend to, or don't like the features, or don't like certain aspects of it. And our research would say that's not true. And our research would also say that the vast majority of end clients would invest in alternatives if their financial advisor recommended it. And I think that's just something that the industry doesn't see. We didn't know what the results of this survey would be, of course, but those results are really very encouraging, not just for Brookfield, and not just for our peers in the alternative space, but actually I think for individual investors, because we certainly would argue that alternatives have a very, very important role in client portfolios.
Yeah, I did find it just, very interesting that how you frame some of this stuff and some of these questions, because there is a lot of research. I mean, we've even done some ourselves about asking about expectations around usage, or like, how much people are using. But I think some of the stuff that you asked here, which got, in a kind of creative way and got under the hood, and even asked about non-users, I found it like, so I did find it like really illustrative, like, because it was learning some stuff about the use of alts, or just the thinking about alts that I hadn't thought about or hadn't seen elsewhere.
Yeah, 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 and it's obviously within the financial community, there's, I'd say, broad recognition that financial advisors who use alternatives in their practice have generally stickier, maybe more successful, maybe higher net worth practices. But I think what's been missed is kind of the chicken and the egg. Anybody can bring alternatives to their practice and consequently get those benefits. Back to your question of why did we do this? It's really to help advisors build their practice by using alternatives.
And one of the ways that you also looked at things in here is kind of classifying folks using alts in some different ways, like alts champions and emerging adopters, and some things like that. So can you talk about that a bit, about these sort of investor profiles that you
Yeah.
found around alts usage?
Yeah. So you're right. We categorized individual investors, so these aren't the advisors, these are
Right.
individuals, into three categories based on their usage. And the category of no, we'll cut this out. I can't remember what the first category is. It's not the power user, but it's, you just said it a second ago.
The alts champions.
Yeah, the alts champions. The category of the alts champion is not surprisingly somebody who is basically a power user for alternatives. In a way, they use alternatives similar to institutions, and that means their allocation is certainly higher, but it also means they're much more diversified, and they look for managers who might manage the quote unquote same asset class, but in a very different way. And that's a dynamic that's changing, which maybe I'll circle back to in a minute. But that's an important category. And then kind of the middle category are the people who are really emerging users, and they are lower allocations, of course, not surprisingly, but importantly are not as diversified, whether that's by product type or certainly manager within a particular product. And then there are those people who really aren't using alternatives, and as we were saying before, their willingness and desire to increase their allocations is meaningful and really encouraging.
Yeah. So in terms of like the usage of alts, we're kind of talking in the broad terms. I mean, you talked earlier about some of the different buckets, but when people are getting exposure, do you find either through the research or even through or through the experience of that Brookfield has had, that folks, like when they come in, they are just coming into like one specific sub part of the early alts, or are they trying to just get like a more diversified exposure to the whole alts universe and trying to have like, get the different risk and benefit profiles of all of these things at once?
Yeah. The short answer is it depends. We as an industry talk about alternatives as this one monolithic thing, and to kind of the undercurrent to your point, it's not. There are lots of different things that can be alternatives. There are liquid alternatives. There are very long locked up 10 or 12-year private funds that have characteristics that are similar to structures that institutions use. There are more semi-liquid structures, which certainly have been the emerging product type in the last several years, which give you exposure to private markets, but do it with the potential of some liquidity, with more frequent subscription periods and redemption periods, and an ability to have your capital deployed immediately. So there are lots of things structurally that are considered alternatives, but then there are lots of things from an asset class perspective that are considered alternatives. As I mentioned before, Brookfield manages real estate, infrastructure, renewable power and transition, and private equity and credit. But there are other things. We happen to be in maybe the biggest ponds. What I would say, though, related specifically to your question, is as the beginning of quote unquote democratization of alternatives started a few years ago, maybe a little bit more than a few years ago, the view was I could have one asset class and maybe one product, one manager in that asset class, and I had this great diversification in my portfolio. Maybe I chose a non-traded REIT, and it was a 5% weight in my overall portfolio, and it was great because it didn't have the same market volatility or beta that public markets have, and it benefited my portfolio. Time has gone on, and people's attitudes toward that thinking has changed, just like it did in long only decades ago, where now the expectation is I have multiple types of alternatives in my portfolio. So I might have real estate, yes, but I might also have infrastructure. I might also have private equity. I might also have credit. I might also have hedge funds. I might also have liquid alternatives, et cetera. And so that diversification is absolutely happening. And now what's happening, maybe more recently, is manager diversification. Not everybody's approach to private credit is the same. Not everybody's approach to private real estate is the same, et cetera. And again, I'm just talking really in the semi-liquid space. If we were to extend the conversation to drawdown type
Mm-hmm.
private funds, then the world opens up even more. And one of the things, just to bring it to the research, that our research would say is that investors generally, except those kind of power users we were talking about before, don't even really understand the different asset classes and different options they have in alternatives, which is why the role of the advisor is so important. But we are absolutely in a space right now where people are diversifying by product and diversifying by investment firm.
Right. Yeah. I mean, it does get very complex very quickly, both in terms of thinking about all these structures. Cause like even the semi liquid, it's like you have tender offer funds and you have interval funds and you have
Yeah,
BDCs and, like there's these
right.
different flavors just of like the semi liquids. And then on the asset side, it's like you could say private real estate, but it's like, as real estate includes like
Is it
four
core? Is it
core
core?
asset,
Yeah, yeah,
four core property types and half a dozen or more alternative property. So it's like, even if you want to get access to stuff, I can imagine it getting very overwhelming very, very quickly, like, right, in terms of like from
yeah.
both an investor or an advisor perspective. And I guess that's why there is so much talk about education and understanding as being kind of like the first step, because it's like
Yeah,
you have to really be able to understand what you're talking about and all these different flavors before you really think about putting people into them.
yeah, definitely. I think as an industry, we don't do ourselves any favors by complicating things as much as we do. If I'm being honest, we joke that no one ever woke up and said that they wanted to buy an interval fund or a non-traded BDC. They woke up and they said they want income, or they want stability in their portfolio, or they want a level of diversification or inflation protection or whatever. Starting with the problem you're trying to solve and working backwards is a lot easier. All those things, the different vehicles as an example, are really the manager's various ways to give clients exposure to private assets. And
Right.
the wrapper or the vehicle matters a lot less at the end of the day. But yet we talk about it, and because we talk about it, people do think that it matters, and I would just frame it from the perspective of a investor's need. We as an example launched a infrastructure strategy a couple of years ago, a year and a half ago or so, and the vehicle is very much, we try and make it very much a secondary part of the conversation. What we talk about is inflation protection, stable
Mm-hmm.
income, stable returns, diversification, owning the backbone of the global economy. Like that's what you want to understand. So it's just but I get it. The complexities get in the way, and I think it's daunting for advisors and clients alike.
So yeah, from your like in the asset manager perspective too, and just thinking about product development, I mean, I know like there's certain ways you have to like talk about this stuff, but just thinking even like in a big picture way, it does seem like a lot of what is happening is really kind of looking at the options, creating a menu, for or creating just like a lineup of lots of things that so folks have choices, right? So like
Mhm.
an advisor can come to Brookfield and look at a bunch of options and think about all these different types and think about what might be good fits. Is that like a fair assessment of like what like is happening on the asset manager side here?
Yeah, it is. Maybe the only caveat to that
Mm-hmm.
that I think is important for advisors and investors to think about is what are the core capabilities of the firm that they're working with.
Mm-hmm.
And using Brookfield as an example, we don't create capabilities for the wealth space. We create wrappers, if you will, for the wealth space. So
Mm-hmm.
all we are doing is taking what we've done for decades and decades and decades for institutional investors and and delivering it in a different way. We if you know if we did created a vehicle that we thought would sell in the wealth channel that wasn't something that we had done for other investors for a very long time, I think we wouldn't be serving our investors well. So it is about choice, as you say, but it's about choice within the confines of what we've been doing for our very long history, if
Right.
that
So
makes
like,
sense.
yeah, definitely sponsor quality, manager quality. I mean, yeah, and the
Yeah,
fact, and people know Brookfield because it, like you said, it's got a reputation from building an impressive track record over the years for what it's done, for institutions. So,
yeah,
I mean, I think it does that from like my seat. That is part of like what is interesting or exciting to be covering here is that there are some like specialty got like smaller asset managers who are coming around doing stuff, but like seeing the real like top of best in class asset managers like looking at the wealth space and trying to provide access just feels like something that's qualitatively different than maybe the way the alts has been talked about in other periods, because I know like there have been periodic times in the past where like wealth should be in alts, but like it wasn't like the
yeah,
Brookfields who were the ones that were doing it, right? I mean, it was. I'm not going to like name names or anything, but like that we are in an era like that's something that feels very distinctive about this current period about why this is gaining traction. This is partly about sponsor quality, partly about manager quality and the expertise. So,
yeah,
um,
yeah. And I think you said it before. We the industry needs education, and it's firms like Brookfield and many of our peers who can dedicate the scale to this business that is necessary to provide education. We have nearly 160 people around the world, most of whom are talking to financial advisors. If you're a smaller firm, needless to say, you can't do that. And that's not to say smaller firms can't compete. They just will compete. They'll compete differently.
mhm.
But we certainly view it as our responsibility to educate, and I think our peers do as well, without putting words in their mouth.
What are some of the ways that you do get in front of actually get in the door and meet with advisors and raise awareness? Like what does that look like? And
Yeah.
how are you out in the world like getting in front of advisors?
So there are a number of different mechanisms for us to do this. If you kind of split the world between we'll call it Brookfield sponsored events and programs and wealth manager sponsored events and programs, we do both. Many of the partners that we work with have a lot of touch points with their end investors and their financial advisors, whether these are alternative symposiums, family office symposiums, et cetera. And we're an active participant in those kinds of things. We also sponsor our own events to get advisors to us. We also have a large team of salespeople that sit around the country and ultimately around the world, and 10 countries around the world, who are out there talking to financial advisors. And so it's that hand-to-hand combat, that the real touch points. But then we publish a lot. Our website is a great mechanism to learn what we think and insights that we have. So it's kind of a multiple touch points across the industry, but we do think it's really very important that we're out there, and it's not just remote.
All right, well, um, I think I've used a chunk of your time here. So, before we exit, I did want to just give you a chance. If there's anything that we didn't get to that you think would be just like really good things, or anything you wanted to underscore for folks before we wrap this up.
Yeah, I think what's important is that this is just the beginning. When you think about what the world was like 40 or 50 years ago in terms of investing in mutual funds, and the diversification or asset classes that people were investing in. Fast forward to today, people have multiple managers for different kinds of funds. They have different styles. They have different approaches that they look for from a diversification perspective. I think the world of alternatives will move in that direction. And not only will it move in that direction in terms of diversification, but in terms of allocations. And, as I mentioned at the beginning, I oversee our institutional business as well. And many of our institutional investors have 50% of their portfolio allocated to alternatives. These are massive organizations. On average, it's hard to get real data on this, but on average, we think about 2% of client portfolios are allocated to alternatives. Contrast that with forget 50%, but even if it's half that in the institutional world, 25%, which is where many wealth managers want their clients to go. There's just a tremendous upside in terms of benefit to clients by getting to that kind of allocation and doing it, as I described before, in a very, very diversified way with high quality managers who are expert in what they're delivering. So early innings, and we're incredibly optimistic, but also here to be of assistance to both advisors and if we can help their clients by helping the advisors, that's what we're here to do, and that really was the basis of the research we conducted.
And so we'll put links in the show notes, but like if you want to say where the best place to find more information would be.
Yeah, I love that question. BrookfieldOaktree.com is our website, and that goes to our website that's dedicated to wealth, where we share a lot of this research, but also insights into different asset classes, insights into various sectors, what we're seeing in the markets, and it's also a good way to get contact numbers and emails and things like that if that's appropriate, and certainly follow us on LinkedIn, and that's Brookfield Oaktree Wealth Solutions, and we love to have followers, and again, we publish a lot on LinkedIn as well.
Well, David, thank you so much for your time and for entertaining my questions.
Thank you, David. It was fun. Thanks a lot.
Okay, David, how do people get in touch with you if they have more questions?
For me, also best is LinkedIn. You can always find me there. And at the wealthmanagement.com site, we have a section for investment coverage where we put everything that we're doing. So that's the best place to keep up with us.
All right, great. Well, thank you. And thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.